Hello. In this session, we are going to continue company analysis, the part 2. We have discussed the part 1 in the previous session, and the company analysis, as you discussed earlier, is a part of EIC analysis for security analysis point of view. And in the previous session, we discussed about the importance of company analysis. We talked about the company analysis and stock valuation. We discussed a broad methodology. In that, we started with strategy analysis. In that, we defined strategy. We discussed about different organization level and strategy decisions. We discussed Porter's 5% model, SWOT analysis, PEST analysis. And in this session, we are going to discuss about the lessons from select authors, and also we are going to discuss about the analysis of financial reports and the ratio analysis to some extent. Coming to the different lessons from select authors, there is certain comments by Peter Lynch, and he has advised certain things that what could be the good attributes or favorable attributes for a firm to decide to invest there. So, those are the things like this. The firm's products should not be faddish. When you say faddish, means there should be a continued in demand for the firm's products. The demand should be there. It should not be that the products are going to be obsolete in near future. That means the company should have a lot of growth potential from the products that company is selling. So, in case the products are becoming faddish, then there should be new products to take care of the new customers demand for that matter. Second thing that the author talks about is the firm should have some long run competitive advantage over its rivals. It should not be like that there is certain advantage like in terms of in price front or something like that. Maybe the company is producing and selling at a very low cost and low price also, and that could be advantage for some period of time. That should not be the case only. The company should have certain long term advantage. Maybe company should be the best in technology. Company should be very much innovative. Company should be coming out with new things. Companies may have a target of producing the things at a lower cost for all the time to come. So, there could be certain company may have some technological tie-ups. So, certain things could be there which will be giving the company certain advantage over the competitors in the market. Then this company will be sustainable and the growth is also sustainable, and that could be one of the attributes for a analyst to invest or choose a company for investment. Third thing that we have in this is the firm's industry or product has market stability. It should not be like that today the product is there, tomorrow it is not there. It should be stable in nature. That means the continued demand has to be there. The other point that Peter Lynch has advised is the firm can benefit from the cost reduction. There should be scope of cost reduction, and the firm should be able to get the benefit out of that, and also at the end the pass on the same to the customers in terms of lower price. So, unless there should be, in fact there should be a continuous program for reducing the cost in any company for that matter without compromising on the quality of the product. Then we have the other lesson from Peter Lynch, that another thing, the firms that buy back the shares, so they are putting money into the firm. So, effectively what happens when the firms buy back the shares from the market, the existing promoters stake actually increases proportionately. So, that is one, and that means the company investors, the promoters may feeling that this particular company actually has certain value, maybe it is not reflecting the market. So, they put a price there and buy back the shares as such, their control itself increasing, means they must have certain interest in the company. That could be another indicator that the company should be invested in. And another thing is that when the companies go for buyback, when they feel that the shares in the market are actually underpriced. So, that is one of the reason for going for buyback of the shares from the economy, from the market. So, since the promoters, their company feels that the shares are undervalued, so it may be right point for other investors to enter this particular stock, invest in this stock. Though other investors may sell the shares to the market to the promoters or to the company, but for some other investors it may be an attractive proposition. So, that is another indication of investing in a particular company. Then we have lessons from this celebrated author and one of the biggest investor as such, Warren Buffett. So, he has classified the tenets into 4 parts: the business tenets, management tenets, financial tenets and market tenets. So, we will discuss one by one. The first thing is the first of the set of tenets, the business tenets. The when in these the author says, Warren Buffett says that what one has to ask question, that is the business simple and understandable. The business should not be very complex, certain products very technologically complex, may not be, the customers will not understand also. So, there should be business structure itself should also be simple and understandable. Once the structure and everything becomes simple, then it will be very easy for the investors or the analysts to estimate the cash flow of a particular company. Similarly, the company or the business should have a consistent operating history. It should not be such new to invest as such. There should have a long corporate history, that operating history also. That means this company has a history of operation. At the same time, definitely in the company's history of operation, it will also have the past financial statements. One can have a look at those financial statements and find out how this company has been actually doing in the past few years as such. Then the business also should have favorable long term prospects. Is this something like that as you discussed in the previous tenets, like Peter Lynch. So, it should not be such that the company has certain products which will be only sellable in a smaller period to the near future, but not for long term future. The company should have that capacity to grow and to produce and sell, provide services for a long period of time come. So, that means to ensure that the long term product performance or service performance is there, the company should have the adequate capability and ability to do that also. So, maybe in terms of assets, technology, tie-ups or R&D efforts, all those things have to be there to ensure that the company has a favorable long term prospect. Then the next thing that is the author has suggested, the management tenet. It says, talks about is the management rationale. When you say management rationale, we should go for the best investment decision. And what is best investment decision is that one should only go for value creating investment opportunity. When you say value creating opportunities, we mean that very simple, that the company should be investing in a project which has a rate of return expected should be more than the cost of capital. So, this is a rate of return R, and this is our cost of capital. On cost of capital is nothing but the expectation of the investors from the company. So, company should be putting money more than in a particular project which should offer a return or expected to earn a return more than what the investors expect out of this company when they finance the company as such. So, in fact, if R is equal to K, then the investors required return is maintained actually, but it is always better that R should be more than K. So, if there are multiple projects to invest, in that case the company should go for that project where this particular spread is higher. That means R should be as much more than K as such. So, that is called the rational investment decision making, and whenever R is more than K in our capital investment decision making, we use a tool called net present value or NPV. So, in case of NPV, we see that NPV is going to positive, then we go for the particular project, and NPV project is positive only when the R is more than K. So, that is one of the rational expected rational behavior of managers in a particular company. So, that is one. And second thing is that management must be candid with its shareholders. That means management must be willing to share as much information with the shareholders. It should not be hiding any information from the shareholders and stakeholders, unless the information is very much strategic in nature, where it can do harm to the company, having a strategic advantages. Certain secrets may not be shared, as unless that is the case, otherwise the information should be shared. In fact, information asymmetry should be the least as the market expects, as such. Should not be that somebody has an advantage of as far as the information of the company is also concerned. So, in any case, the company's management should be willing to share as much information with the prospective or existing shareholders. The next part of tenets is called financial tenets. In financial tenets, the author has advised that one should focus on return on equity, but not earnings per share, because earnings per share itself can have different meaning, in a way that earnings per share itself may not be comparable. We can take a example. Maybe there is a company A and there is a company B, and let us say the paid up capital of this particular company PUC we say is 10 crore, and in this case also it is, let us say, 15 crore, and the reserves and surplus of particular company, let us say 40 crore in this case, and in this case let us say it is 35 crore. So, if you look at both the companies have a net worth of 50 crore. So, this is it's paid up capital plus reserve surplus gives us net worth. So, both the companies are having a net worth of 50 crore. So, company A is having let us say 10 crore rupees of profit during this year, and company B is having a profit of also 10 crore in profit. So, if you compare these two companies, so if you look at return on net worth, then 10 by 50 and 10 by 50 is actually one and same. So, they none of the neither company B nor company A has an advantage over or a better performance over the other company. But whereas if you look at this is called return on net worth, and if you look at earnings per share is nothing but the profit after tax what we have here, profit after tax divided by number of shares. Now, let us presume that this particular company A has shares of face value of share is rupee 1, whereas this particular company has face value of share of rupees 5 each. Now, if this is the case, this particular company has number of shares will be 10 crore, whereas this company will have number of shares as 15 crore by 5, it becomes now 3 crore. So, what happens here, if you go for earnings per share, this company is having 10 crore profit after tax and 10 crore number of shares, then it becomes rupee 1, whereas this company has also 10 crore profit after tax, but number of shares is 3 crore because the face value share is 5. So, 15 by 5 comes to 3 crore number of shares. So, 10 by 3 comes to now 3.33. So, rupees 3.33. So, if you look at this, obviously this company B is in looks like to have an edge over company A, and because it is having a higher earnings per share. So, that is something if you compare it may be misleading, although both the companies have done in the same performance they have made a profit of 10 crore on the overall equity investment of 50 crore. So, that is why an example where you can say earnings per share itself can be actually misleading. So, next we go to something like we have to go for something like calculate the owner's earnings. So, how much the owner is actually making earnings as per investment in the company is concerned in terms of maybe dividend and in terms of the capital appreciation, that has to be also looked at. Then obviously, they are quite natural that one has to look for companies which have a high profit margin, because that is one of the things. Once you have high profit margin, then you have better ability to take care of other expectations. Let us say the operating profit is high, then from that profit one can pay the interest, pay the then tax can be paid, and then adequate money could be there to declare reserve and surplus, to declare dividend, and good amount of profit also can be retained in the business, and the growth can also happen. So, higher profit margin is always desirable for any company for that matter. It may not be possible to earn that higher profit margin during the initial years, but should be a desire for the company to earn as much profit for that matter. Then and another thing, that if there is a reinvestment of any rupee or any dollar in any company, the company has to ensure that the company creates a value of more than 1. So, what happens, there will be certain there will be companies which all the companies make profit. When they make the profit, then they may like to declare some of their profit as dividend, and some of the profit they will retain as the retained earnings, so that it is automatically invested in growth opportunities. So, if the company has let us say made a profit of 50 crore and the company declares a dividend of 40%. So, rupees 50 crore is a profit after tax and dividend payout ratio is let us say 40%, then the dividend declared will be rupees 20 crore, that is 40% of rupees 50 crore. So, retained earnings or earnings retained in this year comes to 60%, that is 30 crore. Now, the point is 30 crore has been kept, means the value creation for every 1 rupee or every $1 of this 30 should be enhanced by something more. It should be something more in future assets. So, 30 crore should actually go up to more than 30 crore in future. It should not be something like that 30 crore itself has actually eroded in the value assets. So, any rupee kept out of the investors money in the retained should be magnified more than 1 rupee as such. Then there are certain things like market tenets. When you talk market tenets, it is talking about a capital market point of view or stock market, financial market point of view. What is the intrinsic value of the business? So, One has to look at the intrinsic value, make a cash flow estimation. When you say intrinsic value, one can look at this free cash flow approach or something like that. So, with approach particular method of valuation, one can find the intrinsic value. Obviously, the intrinsic value is higher than the market prevailing price, it becomes a investment opportunity. If it is lower than that, obviously it is not investment opportunity. So, one has to look at that, and then can the business be purchased at a significant discount to its fundamental intrinsic value. Obviously, the moment the intrinsic value is more than what is the quoted price in the market, if that is the opportunity to buy the company shares at that price, then obviously since it is price is lower than the intrinsic value, so obviously it becomes an investment choice. As much discount to the intrinsic value the price is quoted, it is always better for the potential investor. So, these are the tenets given by Warren Buffett. Then we go to the next section of this particular analysis. We talk about the financial analysis, and in that we talk about the estimating the intrinsic value with different methods. In fact, in our valuation of shares, we have already discussed different methods of valuation. So, we will be just rerunning certain things what we discussed in valuation class, valuation session. Then we will look at analyzing financial statements. In fact, this also we have already discussed in our financial statement analysis session. So, we will be just covering certain nuances of those things. Then we will go to an important aspect called red flags in financial reporting. We can see that the several accounting frauds, manipulations that are taking place in the world as in different companies. We have seen certain companies have closed down because of this financial manipulation, and we have also seen the new rules and frameworks has come by the regulators to control this particular problem. But anyway, these problems can still be there, but one has to be very careful about the figures reported by a particular company in its financial statement. Then we will go for certain measures of value addition like EVA and MVA. Coming to the first part, that is called the estimating intrinsic value, we have got different methods. In that we have got the present value of cash flow approach, and the present value of cash flow approach we have got methods like present value of dividends, then we have present value of free cash flow to equity, and present value of free cash flow to the firm. When we say present value of dividends, what you have popular dividend discounting model where we say the P0 is D1 divided by KE minus G. Now, this is the popular dividend discount model valuation. So, the price of a particular share today depends upon the dividend of next year, and then the cost of equity, that is equity investors expectation, how much they expect, and then G stands for growth rate. We have already discussed these things in our finance and valuation class, but still we can take a small example here. We talk about the dividend. Let us say the present dividend of particular company is D0 and today let us say rupees 4, and let us say the growth in the dividend, and the growth in dividend depends upon the growth in earnings. Growth in earnings depend upon the growth of the company. So, several things which can affect the growth of the company, and then obviously the earnings and the growth in dividend. If the dividend growth is expected to be let us say 5%, and the cost of equity is let us say 15%, then we can find the value of the share as price 0. So, dividend 1 is nothing but dividend 0 into 1 plus G. So, that comes to 4 rupees into 1.05, that is 5% growth. So, that comes to 4.20. So, this 4.20 is going to be the expected dividend in the subsequent next year. So, that is 4.20 D1 divided by KE is 0.15 minus 0.05. So, that gives us 4.20 by 0.1, that gives rupees 42. So, this is the method of valuation where you say that the value of the share applying this particular model is rupees 42, when the dividend today is 4 rupees and expected to increase at 5% for all the years to come, constant growth model, and then it becomes 42 is the present value of the share. So, if the particular share is available for less than 42, obviously it becomes a investment choice. It is more than 42, we do not buy that, rather if you have the share we can sell it. Now, the question is, when in this model we talked about, there is something called cost of equity, which is nothing but expected in return of the equity investors, which depends upon the risk involved in the particular company, and the cost of equity has to capture when equity holder is expecting, he is always expecting a something called risk free rate of return plus any risk premium, some risk premium for the risk investment, because equity investment is risky investment, and there is this particular risk premium can be taken care with the help of beta, that is as per CAPM, capital method applying CAPM and applying beta, one can find the risk premium. So, what happens here, the cost of equity can be we have the formula CAPM, like CF is RA plus beta into RM minus RF. So, beta is taking care of the risk, and the higher is the beta, higher the risk, and higher the risk means higher the reward for the investor as such. So, this in a way it is taking care of the risk as such. So, risk free, that is like the government bond, treasury bill, there is some investment where you get minimum rate of return without any risk involved, you are assured of that particular return. Second, that what you have is the risk premium, and so risk premium plus risk return, that is the investors expected return. So, this risk premium obviously depends upon the company's risk. If the company is in more risky business, obviously the beta can be reflecting that particular aspect as such. So, this is the way one can apply, and then the next method that we have is the present value of free cash flow to equity. So, in this case, instead of using dividend as the factor, we use something called free cash flow to the equity. When you say free cash flow to equity, it is very simple to find out. It's like we have profit after tax, and this is the profit earned by a particular company during a year, and how much of this profit is in terms of we have is available freely for the investor in terms of cash. One thing is that before finding the profit after tax, the depreciation was already deducted, because depreciation is something where tax deductible expense. Once you deduct depreciation, you can, your profit becomes lower and you will end up paying lesser tax, but depreciation does not involve only cash flow. So, we add back the depreciation. So, this is the profit in terms of cash available for the equity investor. Then from that there will be an expansion requirement. So, there could be capex or investment fixed assets, then there could be some working capital investment, net working capital investment. So, whatever the change in working capital is as a delta net working capital, that could be there. Then the company may go for some additional borrowing, because that will also be available for investment or whatever, and then the company could also go for something like repayment of loans. So, having all those things together, that gives us the free cash flow to equity. So, instead of taking dividend as the denominator, now what happens, the value of a particular company equity is now free cash flow, let us say 1 divided by KE minus growth, and the growth is expected growth rate in FCFE, it is not in dividend. So, whatever. So, this is a model. In fact, we can have, this is a model which assumes that the company's free cash flow equity is going to grow at a particular percent for all the time to come, but there can be situation that the growth of a particular free cash flow to equity can be higher for a particular phase, it may be little moderate, then it may go to constant phase. So, we can apply multi-stage growth model that we have discussed already in our valuation class. So, this is one approach. Then we have another approach called the free cash flow to the farm, and there we find the value of the farm, and there we go for free cash flow for the farm here, and then we go for K minus G in FCFF, and the K is nothing but weighted average cost of capital, which if there is company has two sources of finance, then average cost, weighted average cost of, let us say, equity and debt, then it becomes like this. WE is weight of equity in the cost of equity plus WD into cost of debt, that is weight of debt into cost of debt, is weighted average cost of capital, and instead of FCFE we have FCFF, which is the cash flow available for all the investors. That is why the required rate of return is taken here, is that the overall investor expected rate of return, which is known as weighted average cost of capital, which is a weighted average of the two components of finance like equity and debt. There is, we are assuming like that if you have multiple other sources of finance like cost of preference share, one can add this also WP as weight of preference share into cost of preference share capital. So, this could be another way, and how FCFF is derived is nothing but we have got NOPAT, net operating profit after tax, then we will have those capex that is required, and there could be change in net working capital and other adjustments could be there. So, from the firm's point of view, how much cash flow is actually going to be there. So, that is the free cash flow for the firm. Once you have the value of the firm as per free cash flow approach, then one can find out the value of equity by finding out the value of firm minus value of any debt, and maybe value of a preference share is there, as we have discussed the value of preference share capital. So, that gives us the value of equity. So, it is an indirect approach, this is a direct approach to find the value of equity. So, these are the cash flow based measures. Then we have relative valuation measures, where we talk of comparing with other companies or maybe industry or maybe index, we find out the figures there, the valuation measures. We have got something like price earning ratio, the price to earnings per share, then we have got price to cash flow, then we have price to book value, then price to sales ratio. What happens in this case, one will look at the price earning ratio. Let us say, if you take an example, then we will find out the price earning ratio of different companies in that sector or maybe in the part of index, and comparing that we will find an average. And if your target company is the company that you are going to analyze, the price earning ratio is lower than that, then obviously it becomes a better investment opportunity. So, lower P ratio compared to the benchmark P ratio is an investment opportunity to buy, and similarly the higher P ratio compared to the benchmark P ratio becomes an indication to sell as such. So, that is one. Similarly, for other ratios, like same rule can be applied for price to cash flow, price to book value, as well as price to sales per share. Then we can have an example here. We have taken the price earning ratio and price to book value ratio of Sensex based companies as on 21st June 2010. This is on a single day. So, obviously, it may have certain problems that because on that particular day 21st June, maybe the market may be booming, or maybe the price of the shares may be very high or very low. So, it is better will be that take the average share price and divide on earnings per share or book value per share. But in this kind of, for an example, we have taken this, and we see here the price earning ratio of different companies like 10.31 ACC, like that 45.46 for Tata Power Company, and we have got the average of 27.34 and median is 25.11, 4.72, 3.53 is price to book value ratio. So, anything, let us say if median is our benchmark, then any ratio like 4.54 or 10.25 in case of TCS, which is more than 3.53, could be something that is overvalued, and similarly lower than 3.53 could be taken as undervalued. Similarly, case of average and in case of price earning ratio, but there is one limitation of this approach could be there. In this particular chart, we have taken companies from different sector. You can look at that companies like Infosys, we have got a very high price to book value ratio like 7.3. Similarly, TCS has a 10.26. So, possibly one can find out these ratios for a particular industry and then make a comparison whether, and then find out the particular target company is undervalued or overvalued. In fact, average of this particular value like P or PB ratio for a particular industry can be used as a proxy for valuing a company which is not listed, valuing a share of a particular company which is actually not listed. So, that is another approach, indirect approach to find the value of a particular share which is not traded in the market. Next, we move on to how do you go about the analyze growth companies. When you say growth companies, we say that it has a rate of return more than the cost of capital, and so that means R is more than K, and but it could be possible that this could be a temporary nature. So, that means we should not be overwhelmed by that. Then next thing, earnings higher, the required rate of return are pure profits. Okay. So, company any earnings more than the required rate of return is actually the pure profit, or you can say it is the economic profit of a particular company. Then another thing one has to look at is how long this particular excess profit will be sustained. If it is going to sustain for a longer period of time, it is always good. It is sustained for a very limited period of, that means it may not be actually a growth company, it may be for a certain period is showing a growth, but ultimately may come to stabilization phase very quickly. So, that also has to look at. Then another thing is that we will look at is the stock what you have valued is properly valued or not. If it is properly not valued, then you go for alternative methods and then find out, and obviously the intrinsic value is more than the present market price, then it is an investment opportunity. Then we have certain companies which may also have negative growth, one has to be little careful about that. What happens in case certain companies in the early stages of growth, the company retain all the earnings, but reinvestment return may not be that high, it may actually be lesser than the cost of capital. In that case, the growth could be actually negative or growth could be very much minimal as such. Okay. So, or it could be positive, but slower than what it should be, then the value is likely to decline after certain point of time, but one has to look at the particular period of time the growth may be lower or may be negative, but it may actually go up in subsequent period of time. So, one has to look at a higher greater investment horizon and put the valuation of find the valuation of shares of the company appropriately. Then before after doing all this valuation, as we discussed in the PE ratio and PB ratio, we talk about, we want to look at in the industry which are the companies which are good or bad, and so we can compare two firms in the same industry is always better instead of comparing two firms in different industry. And when you compare the industry in two firms in industry, one has to look at the what are the different risks these companies are involved, what are the different is there any inaccurate growth estimates for these companies or accurate growth estimates is there, one has to look for the accurate growth estimates. Then there could be stock with a low P relative to its growth rate, which is actually taken as undervalued. So, actually company is have got higher growth opportunities, but the P ratio does not reflect that. So, one can go for price earnings to growth there and the P is a ratio and find out, and that could be indicated that it is undervalued. Similarly, stock having a high P, but low growth ratio could actually be overvalued. So, like that applying these certain measures we can compare different companies in a particular industry. Then we go to the next part of our financial analysis called historical financial analysis, where you discuss where you consider the financial statements prepared by the companies from year to year and present in terms of annual report, or they declare on quarterly results also. So, looking at those figures, what are the things that we can find out, and then also we look at what are different frauds, different accounting manipulations is possible, and what will be the mechanism for the analyst to look for those manipulations. If there is any problem in the financial statement, financial reports, we will look at will have a look at that. So, the first thing that we have is in historical financial analysis, one is called normalization and adjustments for accounting figures. What happens, certain accounting policies are there which are allowed to be different for different companies. Company can choose the different between different methods of valuation, different methods like inventory valuation, different method depreciation. So, certain subjectivity could be there in preparation financial statements. So, if which is allowed, is not illegal as such, which is allowed by this system. So, if that is the case, if we find out, it is better that we normalize them and then we make them comparable. Another thing we can see that certain companies may extend their financial reporting period maybe by 6 months. So, they may be preparing a report for 18 months, whereas the other companies, comparable companies could be preparing reports, or figures will be there for 12 months. So, obviously, this 18 months financial statement that you have has to be now recast in terms of 12 months, then it becomes actually comparable. So, this normalization has to be done before we go for financial analysis, because on its own analyzing financial statement could be there, but any figure that we find out by analyzing a financial statement has to be compared with the corresponding figure of the industry or some other peer group company. So, for that one has to do the normalization of financial statements. Then one has to look at the evaluation accounting strategy. One can look at the notes to accounts, significant accounting policies, and the company may follow different accounting strategy, because again different accounting methods could be allowed. Like for instance, we used to have in consolidation of statements, and or in case of mergers, acquisition cases and final statements have to prepare for combined entity, we can have something like pooling method or purchase method, and both the methods may be advantageous for under different circumstances. So, that could be an accounting strategy of the particular company, and then company may intend to show good profit or good asset or whatever, that some good financial parameters, it may choose one of them, but in fact the things have become little stringent. So, company may not have that much leeway in choosing the accounting methods, but there could be certain scope for the companies to choose for accounting strategy. So, one has to look at those things which could be disclosed more in footnotes and accounting the disclosures or accounting policies than in the financial figures, that in terms of that is available in financial statements like balance sheet, income statement or cash flow statement. Then one has to look at, as you discussed, one has to look at the review of accounting policies and notes to accounts, because accounting policies in terms of like revenue recognition, expense recognition, or how to treat out contingent liability, all those things can differ from company to company in a particular industry also. So, one has to look at if they are having a certain accounting policy which is totally away from what is the industry practice as such. In that case, the one has to be very careful about interpreting the financial results of such company. Then one has to also look at how much disclosure this company is making, what is the adequate, are they making adequate disclosure, the company is go to the extent of disclosing risk, the management, any contingent liabilities there, any problems with the company for that matter, any governance problem, what is the governance structure for that matter, any environmental law that they have following or not. All those things certain companies go for mandatory disclosure because the regulation provide ask for that. Another thing is that companies always go for voluntary disclosure. So, what type of disclosure they are making, what type of quality of the disclosure is not, disclosure should not be something like that because the regulations say that we are disclosing certain things and just complying with the rules. It should be something coming from the company's management own, whether the rules are there or not, the company is always likely always going to disclose as much. There are certain companies which disclose a lot about their company's performance, the inside story, history, all those things they disclose. That is another indication that companies how well it is governed also. So, we can look at the a sample annual report here is Infosys, and as we discussed we can here we have certain the financial statement of this company, and where we have got the average finance statement of this company, we have got the balance sheet here, the liabilities, and then we have got the assets, then we have the income statement of this particular company Infosys for the latest year 2009-10, and there we can see here the average cash flow statement, then we have the notes to the average, what are the different notes they are following, the company overview, then they are talking about notes on accounts or different accounting rules they are following, they are talking about related party transactions, they are talking about quantity details, then we have the capital commitment, the contingent liability is something which is not reflected in the balance sheet as a part of liability, but is taken as a footnote because this liability can happen depending upon certain things happening, or that it can occur depending certain things happening or not happening. So, that is the contingent liability, and similarly the company has got the consolidated statement also, and there is certain, one can have a look at these statements. So, which is a consolidated cash flow statement, like the company has also has company consolidated balance sheet, income statement, and we have another item as we discussed, there are significant accounting policies and notes to accounts also are provided here, and there are different schedules because it may not be possible for a company to disclose everything about a financial figure in a detail in a balance sheet. So, the explanatory notes are given in terms of schedules as like fixed assets, you can see here the disclosure about the goodwill, building, plant, machinery, computer, what was the previous year's figure, how much has been acquired, how much has been deleted, how much has been impaired, retired, and then we have got the new figures and what is the accumulated depreciation. So, like that all these disclosures are there, and the company also, this particular company Infosys is supposed to be disclosing a good amount. This is one of the company in India which discloses a lot as a voluntary disclosure. If you prepare index of that is good, supposed to be higher in this company. So, you can see here the company has significant accounting policies, like what is the basis of preparation of financial statement, are they following accrual basis, and what are the different accounting standards they are following, what are the use of estimates, then what could be the revenue recognition policy. So, all those revenue recognition, that is one of the very important accounting principle, how do they recognize the revenue for a particular year. So, these are the way one can look at and find out how these companies are following assess the different disclosure norms and all. Then one can use these figures in financial statement as a financial statement analysis, and for that we can adopt ratio analysis as beside other techniques which you have already discussed in our previous session, one of the sessions of financial statement analysis, and in this we actually talk about 5 types of major aspects. The first one is profitability, where we talk about the profitability in terms of the revenue generated, like net profit margin, operating profit margin, gross profit margin, like that, how much profit they are creating in relation to sales. Then profit in relation to investment, like profit related to equity investment, profit related to total capital employed, like return on investment, return on capital employed, return on net worth, return on equity, earnings per share, all those things can be also found out, compared for different companies, and can decide about the company is doing good or not. Then one can look at the next aspect is asset utilization, how efficient the assets are utilized by the company. Typically what happens in asset utilization, we keep the revenue in the numerator, like sales, and divide by, let us say, asset like fixed assets, sales divided by, let us say, inventory. So, that talks about how efficiently this particular inventory has been utilized, how efficient this particular fixed assets has been utilized by this company, and what is this trend in this ratio over a period of time from year 1, 2, 3 like that. So, the ratio is increasing, obviously it is good because the company is efficiently utilizing the resources of the company as such. Then we have got long term solvency. You talk about how solvent is the company to meet the long term commitments of debts, like where you talk about debt equity ratio, we talk about interest coverage ratio, because if they are not taken care, then obviously the equity holders expectation may not be able to, the company may not be able to take care as such. Then we look at the liquidity. In the liquidity we talk about is that how liquid is the particular company, how well this company can actually honor the commitment, the short term commitments, the short term liability, current liabilities. So, companies would have adequate current assets in terms of cash and cash equivalent and other current assets to make to pay for the short term liabilities. And then last thing what you have in this particular category is market performance. How is the performance of the company in the market, like in terms of price earning ratio, in terms of return on by the investors, overall total shareholders return, like in terms of dividend as well as the capital appreciation in the market. So, all those things, the price earning ratio, price to book value ratio, all those things can be also found out the and compared among the companies. These are the different tools of financial statement analysis. Then we move to the one of the very pertaining issue these days is the frauds and the red flags in finance reporting. The companies, we have seen different companies have manipulated their financial statement, reported in different manner, they have not followed the accounting norms, or they have followed in such a manner that we are not able to catch the mistake they have done, deliberately they have forged the financial statements. So, that is something. In any case, financial statement analysis on its own cannot capture the fraud possibly, but it can indicate that could be something wrong, because fraud could be something like intentional. Then the financial statement analysis, when you do that, we presume that the figure that has been presented is actually correct, because they have been audited by the statutory auditors for the company as well. So, we have to trust that particular report, otherwise you cannot go about analyze the financial statement, but there could still be certain manipulations, and possibly looking at the figures in detail and figures over a period of time, comparing with others, one can possibly look at there could be some problems with these financial figures as the company has actually presented. So, look at, so as you discuss, the companies can cook the books and they can have figures which may be suitable. Companies do show profit where they make actually higher profit, and actually they may be making losses or lower profit. Certain times the companies also like to show losses to take advantage of tax shield or something like that, and maybe certain concession they may demand expect from the government or the system. So, for that they may deliberately also show lower profit or less maybe losses for that matter, that could be. So, this is something we also know there is something called window dressing of financial statement. So, then if you can, one can do that carefully, the financial statement analysis can reveal certain unusual patterns that are difficult to rationalize. So, which will say question something called all the red flags, that is known as red flags in the financial statements. Then another thing that you have to look at is numbers on their own may not make any sense. Saying companies may have made a profit of this much crore does not make any sense. How much profit the company has made in relation to sales, how much profit is there compared to last year, how much profit is there in terms of other peers. So, that makes only sense, otherwise the single figure does not make any sense as such. So, in fact, one has to always question the figure itself, even if the figure is good, it should be questioned, the figure is bad, it should also be questioned. Then certain indications could be there that if the asset utilization rate that we discussed some time back, they could also provide some early warning signal. The asset utilization ratios are unreasonable lower, that means there may be something problem, or unreasonable higher also there could be some problem. This could indicate some early warning signal. In fact, what you discuss in this one, the sales of fixed assets, if this particular ratio is continuously declining, that means there must something wrong with that. Why this fixed assets? It could decline because sales could be lower, or it could decline because fixed assets is becoming higher. The company goes for expansion and invest in fixed assets without commensurate increase in the revenue, that means it is a bad sign for the company. Obviously, immediately with the acquisition of fixed asset, revenue may not increase, but once the fixed assets has been invested in, we will expect at least in 1 year 2 years to come, that sales has to take a commensurate with the whatever increase in investment in fixed assets is actually there. So, this could be another example where there could be that yes, there may be some problem. Similarly, let us say sales by inventory or sales by let us say inventory, that the stock, if this particular ratio is increasing or decreasing, let us say decreasing, that means they are having higher inventory to meet the sales, or they are having lower sales, they are having more an inventory for that matter, or inventory is constant but sales itself is declining. So, that could be, that means that company is not able to realize or convert this inventory into sales with quick succession of time as such. Then there could be certain unreasonable unexplained changes could be there, there may be some accounting changes, they might have changed the inventory valuation policy all of a sudden, they might have changed the depreciation method and all of a sudden without giving a substantial reason for that, because there are certain methods allowed by the companies to adopt and the company might have changed that. Then there could be unreasonable growth goals can be there, but there may not be adequate finance to finance the growth. So these are certain indications of something bad may happen in this company. Other red flag that we can see look at financial reporting is that as we discussed earlier, there are certain changes in accounting policies and estimates, estimates especially in the bad days. So estimates of contingent liability, estimates of liabilities for that matter is suppose lower in a particular bad day, or there may be certain accounting policy changed because there is a certain problems may occur. So what they have delivered, they might have deliberately tried to show a different figure of profit or loss of financial statement just to suit the particular environment, particular requirement then. And that is one has to look at, there is some significant changes or there is no change, that is of course it is good as such. Then there could be certain transactions they might have made which could boost the profit. Certain times what happens, they may book certain revenue by changing certain revenue recognition policy, they can manipulate certain times they can boost the revenue by showing higher revenue during the year closing for that matter, but actually sales might not have taken place, goods might not have been delivered to the customers, but still they may recognize that as a revenue by just tinkering the accounting policy. That is one. So one may find out this sudden increase in the revenue in the particular quarter could be there towards particular in the period when the accounting period is ending for that matter. So just to increase the profit they may do like that. There may be certain very consistent margin, that means they could messaging the numbers as such, that means very consistent margin could is unlikely. So because volatility margin is expected, very high volatility is also not expected, but certain changes in profit margin like increasing decreasing is desirable as such, it can always be there, it is can be accepted thing. But if this is very much consistent, it may indicate that the company deliberately trying to show a particular profit margin. So which may indicate that there could be certain manipulation expense front or reporting of expense or reporting of income from this company. Then there could be unusual increase in debtors and inventories in relation to sales. So when the debtors are going to increase, when the credit sales is going to increase. So the company may go for a higher credit period just to lure the customers to buy their goods on credit, and but actually the realization of the credit debtors may not be there. So that is another thing. Similarly, company may go for piling up the inventory, just doing like that, and but there is not corresponding increase in the revenue as such. So this could be another indication that there could be some problem with this particular company as such. Then there could be certain reduction in the managed cost, like suddenly the regular advertisement cost has been decreased. So that could be another indication. Then there may be certain times like non-operating assets can be sold and one time profit could be there, and that itself is increasing the profit, and then the earnings per share and everything can also be increasing for that particular period. So in that case what can be done, one can normalize the financial figures by removing these non-operating items and finding out the profit only from the operating items, and then compare across the time period or across the companies. So that could be one of the, as we discussed, one has to do normalization or adjustments on our own as an analyst, we should do that. Then there could be certain unexplained focus to shift towards non-core business. Suddenly we may find that the company is into some other business than what the company is supposed to be doing. Then there could be certain significant changes in these different segment revenue. Certain segments may be doing very well, certain segments may not be doing very well, because now we have segment reporting practice, we can as well find it out. Then other red flags could be there, like there may be improper method of asset valuation could be there when they do for revaluation and all. There could be certain very high gap between accounting income and the taxable income. Then there could be something increasing gap between the reported income and cash from operation. That is one of the very important thing, that if the profit after reported profit and the cash profit, cash flow is very lot of different, that means the company might have got a lot of subjectivity in the accounting policies and financial statements. Then there could be unexplained write-up could be there. there could be R&D partnership can be there, more R&D could be there. There could be presence of special purpose vehicles to just to take care of certain activities, and they may be outsourcing to that, and then there could be certain manipulation in terms of special purpose vehicles. In fact, we can look at the case of Enron, which used to have lot of special purpose vehicles. So, that used to have revenue transactions with such SPVs which is something non-existent. They used to show that they have made sales to those SPs or SPVs for that matter, because actually they are not, actually there is no much sales that is happening between this company and this special purpose vehicle. So, presence of such SPVs and SPs is actually dangerous, as one of the dangerous signal. There could be a governance structure may not be proper, then may be proper corporate governance, maybe board of management is not proper, there may not be adequate representation from the outsiders, independent members may not be there, and the ownership and finance structure may be very complex as such. So, there could be a lot of cross holding, cross chain holding for that matter. You never know exactly who are the promoters of this particular company. So, these are all dubious things could actually be there as such. Then we have got next measures, the popular measures of finance analysis, that is called economic value added. And then when you say economic value added, we talk about that the company has made true profit. So, it is called NOPAT, net operating profit after tax. There are certain adjustments done which suggested by the propounder of this particular EVA, that they are called Stone and Stewart, and they have given certain accounting adjustments. So, doing the accounting adjustment, the profit we find out net operating profit after tax or net profit after adjustment as a NOPLAT. Then from there you take out the cost of capital and then find out that is economic value added. So, the capital employed is 100 crore and cost of capital is 12%, NOPLAT is let us say 15 crore. So, NOPLAT minus cost of capital is 12% of 100 crore is 12. So, 3 crore is our EVR, which is also known as economic profit. So, once you have, that means the company is earning more than 3 crore than what the investors are expecting as such. So, 3 crore EVA. So, any company which is creating an EVA positive is actually a good company for that matter, and a higher EVA if you create, that if you are earning more in terms of profit more than the cost of capital, obviously it is going to reflect in a higher market price in that then, and that market price will be higher than the book value. And this, then we have another concept called market value added MVA, which is nothing but market value of company minus book value of company. So, once you earn more and more on the investment, obviously the market price is going to increase, value of the company is increase, this is called market, the difference is going to higher, this is called market value of company's book value of company is called market value added. And we can also have another short term measures, shortcut measure, that market value of equity minus book value of equity, which is not net worth, can also be taken as MVA. We are talking in this case it is entire firm point of view, and the equity point of view. So, my MV minus BB, if you assume that market value of companies like this, market value of equity plus book value, market value of debt, then if market value of, similarly book value of companies, book value of equity plus book value of debt, if you assume book value of debt is equal to market value of debt, then it becomes MVE minus BVE is equal to market value added. So, positive EVA companies are actually supposed to be having higher MVA, there is a relationship, and then we have alternative measure also we have in case of cost EVA measurement, where you talk about return on rate of return minus cost of capital. As we discussed in the previous example, 15% is the rate of return and cost of capital is let us say 12%. So, 3% in percentage term is the EVA creation. Then we have the next measure is market value, as I have discussed, and there is always a relationship in EVA MVA, certain findings are there which says that yes, certain authors say yes, there is a positive relations between the companies having EVA and their MVA. So, MVA is going to higher for those companies which has got higher EVA. And also there is another theory which talks about that present value of EVA is equal to market value added. So, MVA is actually a function of EVA 1, EVA 2, like that up to EVA infinite. So, that is also another indication the future EVA is going to drive the MVA particular company today. Then other thing that we want us to look at in case of company analysis is that one should try to visit the companies, seek as much information, ask as many questions to the management, which are actually may not be comfortable for the management to answer, but that should be there, site visits has to be there. So, like that one can look at the companies and find out different aspects of the particular company, and then another thing that one has to look at is the case of stock valuation, because there are different companies across the world. So, one has to look at the global company, and stock analysis can be looked at, where you say that certain things one has to consider is the data available to different companies from different countries. The companies may have different accounting conventions, so one has to make one may have to make some accounting adjustments, certain accounting normalization could be there. There could be certain currency differences also, and the figures may reported in different currencies, then has to adjustments to there. The company may have got different, the countries may have different political risk also. The transaction cost can also be there, that if you are investing in another company in another country, there could be certain transaction cost involved there, and brokerage cost can also be there, and can participate or not, that also has to be looked at. So, all those things are looked at, and there could be certain valuation differences there also, because the country specific accounting policies could be different. So, these are the things one has to look at as far as the analysis of companies in different countries are concerned. So, this is the way we discuss in our EIS analysis. The conclusion, we started with the economic analysis, then we went to industry analysis, then we talked about company analysis, and the companies, both the sessions we talked about strategy analysis and financial analysis, and we also talked about the different accounting frauds and manipulations, or the red flags could be there, which can be found out by carefully looking at the financial statements. Thank you.